you're here because you've come to webinars before. You're a trial member to PowerOptions. You're a subscriber to PowerOptions. You've heard other webinars and other discussions. And I'm going to let you know that I think I made a bold move and possibly a mistake, and we're going to find out together next week. You've heard me talking about how I like to use VIX calls as a market hedge, how I use this in different time periods. And let's go to the portfolio real quick, and you're going to see here a bear call spread, but I want to talk about that first. My market hedge here, I'm going to go to analysis by position. On the 5th of January, I essentially bought 8 calls of the VIX at a price of 118. So it's showing 4 calls here. This is actually not correct. The moneyness, the profit here was just $1,000. Put about $944 into 8 contracts. But there's a little bit of difference here that this is the webinar account. On my actual account, we might look at that later because I want to show you all something else that we're testing. But in any case, we bought 8 calls together on 1.5. Why? Because I've been tracking all of the positions that we sort of recommend or suggest since January 5th, since the first full week of trading in 2026. Monthly and weekly picks of the day for covered calls and naked puts. Of course, my weekly bull put credit spreads that I commonly enter, usually about 3, or it's usually about 3 now. It represents 12 to 15% of my total portfolio. Comparisons on that using a different MACD selection for the bull puts compared to what's worked for me since about 2018, mid 2017, I should say. And long strangles on SPY, which I still have 1 going, and I'm just moving up and down. You're going to see a full presentation on that probably next week as well, of what we've done so far and what we're looking at going forward. And the VIX calls, of course, and some of the other picks of the day and other strategies. But in any case, this was close to accurate, but what really happened is, yes, we bought all 8, $1.18 for the February 23rd call on the 5th, when VIX was down around 18, or I think it was 17 or 16. I'm going to say 1650, just to be fair. But it had just come off a recent run up, and it settled down a little bit, but the prices were expensive. But I was also buying out to February 18th, so we were about 45 days out in time. First spike on the VIX, I'm sorry, was actually January 20th. We sold the first 4, half. When I see that first spike, I sold half. I sold 4 for $1.71, if I'm not mistaken. So we got a $2.16 profit on those 4. This next jump is inaccurate in the sense that I had 4 remaining. So I sold half here on the 21st when it started to pull back, and we only got about $1.41 or $1.42 on the pullback, because the VIX pulls back so quickly after those spikes that when things settled down, the market sort of tamed itself, so we made 92. But in reality, I only sold 2 here. I sold another 2. I'm sorry, so we had 2 left. I apologize. Had 8, sold 4. Had 4 left, sold half, sold 2, had 2 left. Sold 1 at the beginning of February for around $1.30. And I sold the last one yesterday on the peak for only 72 cents. So it took a loss. But the moneyness, the profit made on those positions with those different combinations was still around 308. Now that doesn't sound too exciting. I know it. I know that doesn't sound too exciting. But as far as a trading plan, since January 5th, portfolio created January 2nd, but since January 5th, this little hedge, I only used $1,000 to simulate it here for our webinar account. Usually use this about 2 to 3% of the total portfolio for what? For the unknown, for the unexpected. So it's up about 32% with that trading plan. And now you see a bear call credit spread on the VIX. It's a default search that we have in PowerOptions and bear call credit spreads, weekly bear call credits. And I figured, as the VIX does, when it has these movements, remember the dates I kind of mentioned there. Let's take a look at the VIX here. And when you see the spike, then you see it tend to pull back. And we saw the spike yesterday, and it it stayed neutral today. So I would have sold more, of course, in that case if that had happened. Not sold more, but I would have maybe held on. There we go. Okay, folks, sorry about that. So what I'm referring, but what I wanted to say here is, let me scroll this back a little bit. So January 5th, what do you see? What do we see? We see that first spike that I mentioned on the 20th, sold half, pulled back. So I sold the remaining half here on the 21st, or not the remaining half, I'm sorry. Sold 4, we had 8, sold 4. And then we had 4, and I sold 2, so we had 2 left. This was the spike here on the 7th and 8th, sold 1 here. It settled back down. I was holding the 1 strike more, and on yesterday's peak, or yesterday's spike, that's today's spike, but yesterday's spike, I sold the last one, but I only sold it for 72 cents. So I did take a loss on that, but it was better than the 33 cents that it was down here. So all over in all, that 8 contract investment resulted in a 30% profit so far since January. And again, I'm not always in this position. I'm not always in VIX calls. We usually wait for when we see what we think is the new bottom. And as you can see here, normally Ernie and I would look to open new VIX calls, maybe 20 to 30 days at a time, when we're in the 45 days at a time, maybe, when we're in this lower $14 range. But the more recent lows have been at 16. And then this one is at 17. So it's kind of scaling up. So I'm looking for the new drop to buy new calls. And someone asked me during a coaching session, he said, Mike, I heard you say that you're not in VIX the entire time. You use it as a market hedge, but you only use it when the VIX has hit a low, expecting maybe it's going to come back up. For example, if the market sentiment tool starts to show sell warnings and the VIX is around that 1425, 1450 level, I'm going to go ahead and buy several calls on the VIX in that case. 7, 8, 9, 10, whatever it is for that portion of my portfolio, following some of the rules we've discussed before. So we had our drop, we had our spike, and what do we usually see when we have those spikes? Well, we see it pull back. Had a spike here, pulled back, but then we had a secondary spike. That's what I'm worried about. And then it pulled back. And then we had our spike here. All right, we got the inflation report today. We know there's other earnings coming out next week. Remember, the standard expiration for the VIX, of course, is on Wednesdays. With that in mind, I did a bear call credit spread on the VIX. I only used 3 contracts, using up the profit plus a little bit extra, an extra 200. I remember the accounts that portion of the portfolio is up 30%. But we made 300 and some profit on those VIX call transactions, roughly about 380. So I took that and some of the extra, did 3 contracts, and I'm in a bear call credit spread on the VIX for Wednesday's expiration. Sold the 23 call, bought the 25. It's a net credit of 66 cents. As we saw in the portfolio, expected only about a 12.4% return, $66 against the true risk of about 534, 535. I would never suggest to any of you that you do this, honestly. But I wanted to try something. I think I might have been better doing a bear put debit spread on the VIX that was maybe 20, 25, 30 days out in time and closer to at the money. This was, by the way, at the time, the 23rd call 5 days away, was a 0.3 delta. It was less than that, actually. It was about a 0.26. It was an 82.9, 83.1% probability of expiring worthless in 5 days based on the history of the VIX. That's a scary statement because the history of the VIX, following it like a stock, it doesn't track like a stock tracks, does it? No. Anything could happen in the next 3 days. This could spike up to 24. It could spike up to 26. It could spike up to 22. But I wanted to put myself to task for that investor that asked, why don't you trade it the whole year round? So when you have these spikes and you think it's going to pull back, why don't you take advantage of it? So I'm testing this and actually put a little bit of money into this from our weekly bear call credit spread default search. It's called weekly spreads on the VIX But it's just another idea. It's just something to play with, but to let you know, hey, I make mistakes too. What has been working for me? Hey, this VIX call idea has been working for me for the past few years, since about 2018. I think it was beginning of January 2018. I've used this every time when the VIX is in a lull and we start to see the sell warnings appear on the market sentiment. That's the only time. And as I mentioned during a coaching session this week, I was challenged to say, well, why don't you use it on a more regular basis? If you're expecting it to do this, then do that. But it also depends on market conditions, right? We had a big gap up the other day. We had a gap up due to the fact of concerns on tech and the NASDAQ falling, gold and silver falling, all of that. And you say, okay, well, you're expecting it to settle down because that's what it usually does. And then you have to hesitate and say the VIX is not like a normal stock. Because if anything happens over the weekend, and I've given myself 3 days to be fouled over on this position by any news that comes out, if any escalation of the different global conflicts around the world, something happens during the Olympics, by the way, something happens during that time period. We don't want to think about it, but there's some kind of terrorist event or something in Milan Cortina, the VIX is going to shoot up, and that bear call credit spread is potentially going to lose. And it could potentially lose a lot because it's only a 3-day trade. So it's a bit of a risk. I'm not going to advise doing it, but because I was asked, I'm going to try to see how this does and compare it against that bear put debit spread. It's a little bit more at the money and a little bit further out in time to give me more time in case the sudden flux happens. I think that's a good approach too. And of course, we also have our long strangle, as I mentioned, on SPY and SPX that we're using. Patrick says, when a dollar sign precedes a stock symbol, it's usually not tradable. Is that a correct statement? What is used to trade the VIX? That is a correct statement. And what he means is on our symbology on PowerOptions, we use a dollar sign for the index. Dollar sign VIX. I want to see the chain on SPX. I got to use dollar sign SPX. What Patrick's referring to is I can't buy the underlying. Can't do it as a married put. Can't do it as a straight covered call. I could do synthetics if I wanted to, but I can't buy an underlying. All right. The VIX itself, Patrick, is based on the volatility futures, which I think are 2 to 3 months out in time, if I'm not mistaken. So when the change happens and the futures change, that drives the underlying price. Now, that being said, in the past, you've all heard me discuss this as well, and you can see it. Let me go to our YouTube channel real quick. Let's go to playlists. And I want to view the full playlist for market hedges for unexpected events. And reviews VIX as a market hedge. We're going to have some more updates on that. As you can see here, we're talking about more strategy driven, more concept driven. Hedge my portfolio or stocks directly. Bear put debit as a market hedge. This one compared buying puts on SPX, buying puts on SPY versus doing a bear put debit and VIX calls in a 7% drawdown period, Patrick. Analyzing hedges on large portfolio and best index to hedge a portfolio. And why am I bringing this up? The reason why I'm bringing this up is back in the day when I first started trading, coming up with the concept, and everyone had this concept before. People were doing this. I was trying to narrow it down to what is a pattern that works extraordinarily well. And what I looked at in that case is I used to use VXN, which is now VXX. And so VXX is the short-term futures exchange traded note. And here the follow-up question is, VIX is future-based. Are you subject to future rules and our tax reporting? Well, it depends on what I'm trading it in. If what I mean by that, Patrick, is if I'm trading it in my IRA account, I don't worry about any of that. No, I'm not subject to future rules at all. It's an option contract. You're buying an option contract, so it follows into the same tax principles of buying calls or buying puts and how you'd profit on that short-term, long-term capital gain, short-term capital gain. It's the same thing, Patrick. The account's as just an option, even though it's based on the futures. But sometimes when you get in trouble, so for example, sometimes when I get into trouble in a bear call credit spread, as I have open when VIX right now with the 23.25 strike for February 18th, I may repair that by buying shares of stock if I have that money in my portfolio. You can't do that with the VIX. So I started playing with the Volatility ETN. Now, these are weird. Let me see if VXN should not still be in the system, but let me just check real quick. Yeah. In 2018, 2019, when I mentioned I was doing this, the symbol was VXN. And as an exchange traded note, as many of you know, it sort of has its own expiration, meaning the underlying has an expiration of the contracts on it. And when it gets close to running out, they change the symbol. So VXN changed to VXX. And it's still the same thing. It doesn't show as much drastic movement. You do see movement. Let's just take a look at the chart again. I should have just gone to the 3-month snapshot. I apologize for that. But yeah, we're going to go here. There we go. Okay. So let's shorten this down. So we see the similar chart patterns of the spikes that we talked about on the 20th. And they're just not really as severe percentage-wise. And so that's why I stated with the VIX at the time. And the VIX is also, in my opinion, more heavily traded than VXX or VXN was. And so that helped with some of the options trades. But there is a benefit to using this, buying VXX or VXN straight out as a market hedge, where you don't have to worry about the time value that you paid into it. You don't have to worry about the time value decay. But I would still sell half. If I bought 50 shares, I'd still sell 25 on that first spike. And then if it fell the next day, I might sell half of that, let's say 12, and then just hold it. And then when it spikes again, sell the other half, because it's not leveraged like the VIX calls or the VXX calls. So I do want to do an analysis on that. I've done it in the past, and that's why I don't do calls on VXX as a replacement for what I do with VIX. But it might be safer to do a bear call or a bear put on VXX in these times when I think it's going to come down to continue trading VIX as a market hedge. Switch between the ETF is a good point, Patrick. But yes, if you wanted to do a covered put strategy or a married call, when you're thinking the VIX is going down, shorting VXX, I wouldn't want to see you do that. It'd be better maybe to just do a debit spread, bear debit spread, or bear call credit spread on VXX.